Key ideas in quantitative finance: swaps. The first swap in the world happened in the 1980s. It was a swap between IBM and between the World Bank. It was in fact a currency swap that exchanged Swiss francs for US dollars. But why swaps are important and being relatively recent in the history of derivatives, how come they have arrived to be the king of derivatives, the most common derivative by mark-to-market and by notional values according to the International Swaps and Derivatives Association and the Bank for International Settlements are swaps. Why is this so? Well, let us look at the contract, and that will give us an idea of why swaps are very interesting contracts and very useful contracts. A swap indeed is a contract which allows two parties to exchange a series of cash flows at certain regular intervals. The most common swap is the fixed for floating swap, when one series of cash flows is indexed to a fixed rate and the other series of cash flows is indexed to a floating rate. Payments are computed using a notional amount. And indeed, cash flows are contracts in which we have these payments, in which we have regular payments. The most common swap has a maturity of 5 years. Payments could be every 3 months, so capital T is 5 years. Delta T is intervals in which payments happen are 3 months. The fixed rate is denoted here by F. The notional amount, which is not actually exchanged in most swaps, but is used to compute the value of the cash flows that are going to happen, the value of the payments. This notional amount could be in amount of dollars or sterling, and typical amounts are $5 million. The floating rate L_I represents a benchmark rate in the markets that is going to determine how much is going to be paid at each payment date. The contract itself involves two counterparties, involves us and involves some bank. We're going to exchange these cash flows, as we said, and we're going to pay a fixed rate to the other counterparty, and we're going to receive a floating rate. Of course, this could be swapped, this could be changed, the order of these cash flows, but in this case, we have the paying the fixed and received the floating. The payments happen at regular intervals, and this we denote by the values T_1, T2, T3, and T4. This could be 3 months, 6 months, 9 months, and 12 months. So let's take the counterparties A and B, and let's take the investment line. And we have this as seen from point of view of A. So if cash flows go up, they are positive. If cash flows go down, they are negative. And here we're going to have our payment times. We're going to have the 4 payment times, and we're going to have the series of cash flows happening. Some going down, some going up. The ones going down are paid from A to B. The ones going up are done from B to A. We are at time t equals 0. We are pricing this swap with the valuation date of today. And what we have to do is to discount these future cash flows to the present, to today, to be able to estimate what is the price of this contract that we called a swap. The critical variable, the critical thing that we want to calculate is the mark-to-market. So the pricing involves doing this discounting of all the future cash flows, considering some of them positive, the ones we receive, some of them negative, the ones we pay. And to do this, we'll need to determine what are the floating interest rates that are associated with these cash flows. The fixed ones have a fixed rate, a rate which could be 3%, and it's always 3%. The fixed rate during all these 4 intervals that we have in this contract. However, the floating rate indeed is variable, is changing, and it could have a value L1 in the first period, L2 in the second, L3 and L4 in the fourth period. So it will change with time as the time passes and the financial markets change these rates. This rate could be LIBOR or it could be Euribor rates, typically 3 months if the payment periods are 3 months as well. So the whole price of the legs, the series of cash flows, the fixed cash flows are called the fixed leg, and the value of this fixed leg in the bottom of the page here is the summation of all the payments that happen during these quarterly periods for this year. This swap has 4 quarterly periods. Each payment then has a value of F, which is a rate, is the fixed rate, times the notional, which has the currency units, times delta T, because the rate is annualized and therefore we have to transform it to be a cash flow in that period, and times the discount factor, because this cash flows happens in the future. We add all these things and we have the value of the fixed leg. The value of the floating leg, the one we see on the top, is very similar. For each of the cash flows, we're going to have a rate. The rate is going to be L1 for the first, L2, L3, and L4 for each of these payments. And when we have these rates, we're going to be multiplying each of the rates by the notional to multiply a percentage rate times a money, which notional is, times delta T, so that the value of the rates, which is annualized, applies to the period in which the payment happens, and then times the discount factor, so that we bring to the present all those payments that we have happening there. The mark-to-market of the swap, as observed at time 0, is going to be the value of the fixed and the floating added, considering that the fixed is paid, the floating is received, and therefore by adding these two series of cash flows, we obtain a formula that represents the mark-to-market of the swap. That is the price of the swap. But here we have something that is very difficult to determine, and even though we have an estimate at time 0, is not a constant value that is going to remain during the life of the swap. And this is the benchmark floating rates, the L_I that we have here. So what about the forward rates? These rates that we pay, L1, L2, L3, L4, these are the forward rates. These are going to represent, in the case of a swap which pays quarterly, they're going to represent, for example, LIBOR 3 months observed today for the first rate, then LIBOR 3 months observed 3 months in the future, then LIBOR 3 months observed 6 months in the future, then LIBOR 3 months observed 9 months in the future. So it is the same rate, but observed at different moments in time. This is what the swap involves. And that's why these swaps are used very successfully to hedge against interest rate risk, because they allow us to transform a floating rate into a fixed rate. And by doing this, a business will know exactly how much it will pay for certain debts that it may have in the future. The spot rates and the forward rates are related through an arbitrage argument as well, so we can easily transform between them, and knowing the spot rates such as LIBOR 3 months, 6 months, 9 months and 12 months, we can determine what are the forward rates that will be the LIBOR 3 months at different periods during those quarterly payments that the IRS should have.